Did you know that the VA has backed over like 40 million home loans since the program started?
Yeah.
It's a huge number.
It really is staggering when you think about it.
Okay, so let's unpack this for you. You're here because you want the straight facts on VA home loans, right? Without getting bogged down in all the jargon.
Yeah, maybe you're a veteran, maybe family, or just curious.
Exactly. And this deep dive, it's based on the official VA Lender's Handbook. We're aiming to give you the core knowledge.
And that's the goal today, really. To boil down what's in that big handbook, we're talking about who's eligible, what's this certificate of eligibility, the COE, all about.
And how the basic VA-backed loan works. The fundamentals.
Yep, straight from the source material.
Think of it like your essential guide. We'll cut through the complexity.
And, understanding this stuff isn't just academic, it's practical knowledge. For your own situation, maybe helping someone else, or even professionally.
Definitely. So let's jump right in. Eligibility. What does that actually mean for a VA loan? What's the first thing?
Okay, eligibility. Fundamentally, it means you meet the minimum service requirements, length of service, character of service, that kind of thing.
Gotcha.
But here's a key distinction. Eligibility is not the same as entitlement.
Ah, okay. Explain that.
Eligibility gets your foot in the door. It says, yes, based on service, you can apply for this benefit. Entitlement, though, that's about the amount the VA will guarantee on your loan.
So being eligible doesn't automatically mean you get the loan.
Not at all. You still have to qualify based on your credit, your income, the usual financial stuff lenders look at. Eligibility is just step one.
Right. Makes sense. And the document that proves this eligibility to a lender, that's the certificate of eligibility. The COE.
Exactly. The COE is the official thumbs up. It tells the lender, this person meets the basic service criteria for the VA loan benefit.
And lenders need this.
Oh, absolutely. They typically need a valid COE before they can even order an appraisal or, close the loan. It's crucial. No COE generally means no VA guarantee.
Okay, so how do you get one? How does a lender or maybe the veteran themselves get their hands on this COE?
The primary way, the preferred way, according to the VA, is online. Lenders use something called the ACE System Automated Certificate of Eligibility.
ACE.
Yeah, they access it through the VA Information Portal, or VIP, then into WebLGY. Often it's almost instant.
Oh, yeah.
If the system needs more info, maybe some documentation isn't automatically verified, the lender can submit an electronic application with the necessary proof. That goes to a VA Regional Loan Center, an RLC.
And can veterans get it themselves?
Yes, they can. Through the eBenefits portal online, or they can mail in a form, VA Form 26-1880. But honestly, the online ways are usually much, much faster.
Good to know. Now, what about IRRLs? Those interest rate reduction refinancing loans?
Yeah.
Does the COE work the same way there?
IRRLs are a bit different. For those, if the lender successfully gets a VA case number through WebLGY, they don't always need a separate COE.
Why is that?
Because the system itself verifies, there's already an active VA loan being refinanced, so eligibility is kind of confirmed in the background when the case number is issued.
Got it. So for a standard purchase or a cash-out refi, COE is king. But for an IRRL, maybe not always needed separately.
Pretty much, yeah.
Okay, so the lender gets the COE. What key information is actually on it? What are they looking for?
Well, first and foremost, it confirms eligibility for the benefit itself. Again, not the loan approval, but the right to use the program based on service.
Right.
Then, critically, there's the amount of entitlement.
Okay, tell us about that. What does that number mean?
It'll show the veteran's basic entitlement. Currently, that's set at $36,000. Think of it as the initial layer of the VA's promise to the lender.
Basic entitlement, $36,000.
Yeah, but it might be less if you've used some on a previous VA loan and haven't had it fully restored yet.
Okay.
And for loans over $144,000, there's also what's called bonus entitlement. This isn't usually spelled out as a dollar amount on the COE itself.
How's it shown then?
Often, there's just an asterisk next to the word available, pointing to a note that explains this potential extra guarantee. For these bigger loans, the VA generally guarantees 25% of the loan amount.
Up to certain limits, right? Those county loan limits.
Exactly. Those limits vary depending on where the property is. You gotta check the VA website for the specific county limits. The 25% guarantee applies up to those limits.
So what if a veteran has used their entitlement before and it's not fully restored? What does the lender do then?
They have a few options. One, they could proceed with the loan, knowing the VA guarantee is limited to whatever entitlement is left.
Which might mean more risk for them.
Potentially, yes. Or two, they can help the veteran apply to the VA to get their used entitlement restored, if possible.
Okay.
Or three, the veteran might need to make a down payment to bridge the gap, to offset the reduced guarantee amount.
Right, reducing the lender's exposure. Okay, now another field on the COE, the funding fee field. What's the story there?
The funding fee. This field tells the lender if the veteran is exempt from paying it, non-exempt, or if they need to contact RLC.
Exempt, non-exempt, contact RLC. What makes someone exempt?
Usually, it means the veteran is receiving compensation for a service-connected disability. The COE might even show the monthly disability payment amount.
Okay, and non-exempt.
That generally means they aren't automatically exempt. Maybe they receive a non-service connected pension, which might require prior VA approval for an exemption, or simply they don't meet the exemption criteria.
And contact RLC.
That pops up if the automated system couldn't make a clear call, or if the loan itself might need prior approval from the VA for some reason. The lender usually has to fax a specific form, VA Form 268937, to the RLC to figure it out.
Gotcha. And for IRRLs, is the funding fee status on the COE too?
For IRRLs, it's actually shown in WebLGY when the lender requests the case number. They see the exemption status right there in the system.
Now, if the COE does show exempt status, can the lender use that for anything else besides just the fee?
Yeah, potentially. First, it's official proof the fee isn't required. Saves paperwork. Second, if the COE lists a specific disability income amount in the conditions section and shows exempt, lenders can often use that figure as verified income for qualifying the veteran for the loan.
Oh, interesting. So it can help with income verification too.
Sometimes, yes. Though if the amount seems different from, say, a recent bank statement or award letter, the lender should go with the most current proof, like the award letter or statement.
Makes sense. The handbook also mentions additional conditions listed on some COE forms. Sounds important.
Very important. These are specific flags or notes the lender needs to pay attention to. Table 1 in the handbook breaks them down.
Like what? Give us some examples.
Okay. If it says active duty service member, the lender needs to verify they're still active duty at closing. Might need a special certification.
Right.
If it says excluded entitlement, that means any remaining entitlement can only be used for a cash-out refinance on the exact same property tied to the prior VA loan. No new purchases with that bit.
Very specific.
Yeah. Then there's one-time restoration. This means the vet got their entitlement back without selling the previous house.
Okay.
But the catch is, for any future restoration, they'll have to sell all properties bought with a VA loan.
Wow. Okay. So that one-time use has big downstream effects. If you used it, say, moved from Maryland to Georgia, to get entitlement back again, you'd have to sell the Georgia house and the Maryland house.
That's the implication, yes. You have to dispose of all VA-financed properties for subsequent restorations after using that one-time option.
Good to know. What else?
Conditions like non-service-connected pension or fiduciary usually mean the loan needs prior approval from the VA before moving forward.
So extra steps involved.
Right, and subsequent use funding fee is just a heads up to the lender that a higher funding fee applies because the veteran isn't a first-time user of the benefit.
Okay, so the COE is packed with crucial info. But getting one requires proving your service first. What docs are needed? Let's start with discharged regular military.
For discharged folks from regular Army, Navy, Air Force, Marines, Coast Guard, the key document is usually the DD-214.
Discharge papers.
Yep. Specifically for separations after October 1st, 1979, they prefer member copy 2, 4, or 8. Those typically show the character of service and the reason for separation, which are important.
And before 1979.
Pre-1950 separations, the documentation just needs to clearly show the length of service and the character of service. Might not be a standard DD-214 format.
Okay. What about people still serving active duty right now?
For active duty members, they need a statement of service, or SOS.
Is that a specific form?
No, there isn't one standard VA form. It's basically an official letter from their command. It has to include specific things, though. Full name, SSN or last four, date they entered active duty, any lost time, like AWOL or confinement, and the command's contact info.
Got it. Official letter with key details. Now, reserves and National Guard, discharged members first.
Right. Reserves and Guard members typically don't get a DD-214 just for their reserve time unless they had qualifying active duty periods. So for discharged Army or Air National Guard, they usually need NGB Form 22 and NGB Form 23B.
NGB form.
Yeah, National Guard Bureau forms, plus proof of the character of service. For reserves, it's usually their retirement point statement and a character of service document. That annual point summary is often key.
And what about current members of the Guard or Reserve? Still drilling.
They also need a statement of service, like the active duty folks, but there's also needs to state the total number of creditable years they've served, meaning years where they earned enough points.
Okay, so drilling years count.
Right. And if they were called up to active duty under Title 10 or Title 32 orders, they'll need copies of those orders too. Importantly, just being in, the inactive ready reserve or some non-drilling status usually doesn't count as eligible service time. You need to be in an active drilling status.
Makes sense. What if someone's having trouble finding these documents? Like their DD-214 is lost.
Yeah, that happens. The handbook suggests a few places. They can request records from the National Archives. Sometimes info is available through the eBenefits portal. Or they can fill out Standard Form 180, the SF-180, and mail it to the archives.
SF-180. But don't send it to the VA.
Correct. Send it to the National Archives or the relevant record center. But the handbook also notes, especially for active duty service, the VA's internal systems often have enough data already. So lenders shouldn't necessarily hold up requesting the COE just because the physical documents haven't arrived yet. Apply first.
That's good advice. Don't delay.
Yeah.
Okay, we've got the proof of service. So the fundamental rules for eligibility based on that service. What are the time requirements?
The general rule, going way back, is active duty service after September 15th, 1940. Discharge must be under conditions other than dishonorable, and the length. At least 90 continuous days during wartime, or at least 181 continuous days during peacetime.
Wartime versus peacetime. Are those specific periods defined?
Yes. The handbook has Table 2, which lists the official dates for World War II, the Korean War, Vietnam, the Gulf War, and the current post-9/11 era, defining which periods count as wartime. Anything outside those is generally considered peacetime for eligibility purposes.
Okay. But you mentioned longer requirements for some people.
Right. There was a change. For anyone whose first enlistment began after September 7th, 1980, or for officers whose first entry to active duty was after October 16th, 1981, the general requirement is longer.
How long?
Usually 24 continuous months of active duty, or the full period for which they were called or ordered to active duty, as long as that full period wasn't less than the basic 90 days wartime, 181 days peacetime minimums.
Okay, so a 2-year rule for many who joined after the early 80s, unless they served a shorter full tour that met the minimums.
Pretty much. It covers most people who've served since then.
Got it. And let's circle back to Reserves and Guard again. What's their specific time requirement if they don't have that 81 days of active duty?
For Reserve and Guard members whose eligibility isn't based on active duty periods, the standard is 6 years of honorable service.
6 years.
6 years in an active drilling status. Again, inactive time doesn't count. The discharge must be honorable. A general discharge, or under honorable conditions, usually isn't sufficient for this path.
But there's an exception for disability.
Yes, if they were released earlier than 6 years, specifically because of a service-connected disability, that 6-year requirement might be waived.
Okay. Now, eligibility isn't always just the veteran, right? Spouses can sometimes qualify.
That's correct. There are several scenarios for surviving spouses. The most common is the unmarried surviving spouse of a veteran whose death was service-connected.
Service-connected death, okay.
Also, if a surviving spouse receiving DIC dependency and indemnity compensation remarries after age 57 and after December 16th, 2003, they might retain or regain eligibility.
Interesting nuance there with remarriage age and date.
Yeah. Then there's the spouse of a service member who's listed as missing in action or a prisoner of war for over 90 days. They get a one-time use eligibility.
One-time use for MyPOW spouses.
Right. And there are also provisions for surviving spouses where the veteran's death was not service-connected, but the veteran met certain disability criteria at the time of death. Topic 3 of the handbook details those specific conditions. Plus, as mentioned, spouses receiving certain types of DIC payments might qualify.
Seems like several possibilities for spouses. What about other qualifying service?
Yeah, the handbook briefly mentions folks like commissioned officers of the Public Health Service or cadets at the service academies. For those rarer cases, the advice is for the lender to contact the RLC for specific guidance.
Okay, and you mentioned exceptions to the length of service, LOS requirements too.
Absolutely. The big one is discharge due to a service-connected disability. If that happens, a veteran might be eligible even with very short service, potentially even just one day if the discharge was for that reason.
Oh, one day.
Yeah. Because there are various specific rules depending on why someone was discharged early, the handbook doesn't list every single possibility. The advice is basically, if unsure, apply for the COE anyway. Let the VA make the official determination. Don't self-screen out.
Good point. Always apply. Okay, so let's say a veteran used their benefit, bought a house. Now they want to buy another one. Can they get their entitlement back? How does restoring entitlement work?
Yes, you can potentially reuse the benefit. The most straightforward way is basic restoration. This happens if you've sold the property you bought with the VA loan and the loan has been paid off completely.
Sold the house, paid the loan. Simple enough.
Or another way is if you sell the house and another eligible veteran assumes your VA loan and agrees to substitute their entitlement for yours.
Okay. Substitution.
Right. Those are the standard ways. Then there are what the handbook calls special restoration cases.
Like what?
One is if you do a regular cash-out refinance on the same house you originally bought with a VA loan after that original loan was paid off, you can restore entitlement used on the original loan for that purpose.
Okay. Refi on the same property.
The other big one is the one-time restoration. This is where you've paid off your previous VA loan, but you haven't sold the property. You still own it.
Oh, you kept the first house.
Exactly. The VA allows you, just once, to restore your entitlement to buy another primary residence.
Okay, that sounds useful. What's the catch?
The catch we mentioned earlier. The COE gets marked with that one-time restoration condition. If you ever want to restore your entitlement again after using this option, say, to buy a third house or do a cash-out refi on the second house, you first have to sell both the first house, the one you kept, and the second house, the one you bought with the one-time restoration.
Right. Dispose of all properties obtained with a VA loan at that point. That's a significant limitation to understand.
Absolutely critical to understand the long-term implications.
Now, on the flip side, can entitlement be misused? Are there rules about how you use the property?
Yes. The absolute fundamental requirement is the veteran must have a bona fide intention to occupy the property as their primary residence.
Intent to occupy.
Right. So arranging to sell the property or transfer ownership to someone else before the loan even closes is considered misuse of the benefit. You can't use it just to flip a house or buy for someone else who wouldn't qualify.
Makes sense. What if there's a gray area? A weird situation.
If a lender has any doubt about whether a planned use is legitimate, the handbook tells them to contact the RLC for guidance before proceeding. Better safe than sorry.
Okay, good advice. All right, we've covered eligibility, the COE, proving service, restoring entitlement. Now let's shift gears to the loan itself. Chapter 3 stuff. What are the basic elements of a VA guaranteed loan?
Okay, Chapter 3, first big point. The VA itself doesn't actually set a maximum loan amount that it applies across the board.
Really? That's surprising. So there's no VA limit?
Not a hard cap from the VA, no. The loan amount is really influenced by two main things. One, the reasonable value of the property, determined by the VA appraisal, that notice of value, or NOV.
The appraisal value.
And two, the requirements of the lender, especially if they plan to sell the loan on the secondary market. Those investors might have their own limits or guidelines.
Interesting. So that connects to the down payment then. Generally, no VA down payment required.
That's usually the case, yes. The VA doesn't require a down payment unless, one, the purchase price is more than the appraised reasonable value.
Okay, got to cover the difference.
Two, if it's a specific type of loan called a graduated payment mortgage, or GPM. Or three, if the lender or the secondary market investor requires one for their own risk assessment. But VA itself usually zero down required if the price matches the value.
That's a huge benefit. Now, the VA guarantee itself, we keep saying VA guarantees the loan. What does that mean practically for the lender?
The guarantee is the amount the VA promises to repay the lender if, unfortunately, the veteran defaults on the loan and the lender ends up losing money through foreclosure.
So it's like insurance for the lender.
Exactly. It protects the lender against a portion of the potential loss, which makes them more willing to offer these favorable loan terms, like no down payment.
And in return, the veteran has to promise something, right?
Yes. The veteran has to certify their intent to personally occupy the property as their main home.
Occupancy certification. Is that always required?
Almost always for purchases and regular refis. The main exception is for IRRLs, those rate reduction refis. For an IRRL, the veteran only needs to certify that they previously occupied the property.
Okay, slight difference for IRRLs. What about interest rates and points? Does the VA set those?
Nope. Interest rates and any discount points are fully negotiable between the veteran and the lender. The VA doesn't regulate them.
And points, those fees to lower the rate. Who pays those?
Points can be paid by the veteran or the seller. The VA just requires that the amount charged is reasonable. Generally, points cannot be financed into the loan amount except, again, for IRLs where up to 2 points can potentially be financed.
Got it. So the VA's main role is providing the guarantee to encourage lending. How about underwriting? Does the VA tell lenders how to assess borrowers?
They provide guidelines, yes. VA underwriting is generally seen as more flexible than for conventional loans. Lenders look at the usual things: credit history, ability to repay.
Income stability.
Right, stable income is key. They also look closely at residual income.
Residual income. What that?
It's the money left over each month after paying major expenses like the mortgage payment, taxes, insurance, other debts, and estimated family living costs. The VA has tables based on region and family size to gauge if the residual income is adequate.
Okay, money left over after bills.
Yeah. They also look at the debt-to-income ratio, or DTI. If the DTI is over 41%, lenders need to take a closer look and usually require compensating factors like significant savings, long job history, etc., to approve the loan.
So flexible, but still requires solid financial footing.
Definitely.
We've touched on IRRLs a lot. Let's summarize their key features for someone with an existing VA loan.
Okay. IRRLs, interest rate reduction refinancing loans. Main goal: refinance an existing VA loan to get a lower interest rate and payment. Big pluses: usually no new appraisal needed and often no full income credit underwriting required.
Streamlined process.
Very streamlined. Closing costs can be rolled into the new loan amount. Discount points are allowed, but usually only up to 2 points can be financed.
Kinky cats.
Key thing: generally, no cash back to the borrower is allowed, except maybe for recouping the cost of energy efficiency improvements financed at the same time. Also, if you refinance from a fixed rate to an adjustable rate mortgage, ARM, the rate might actually start higher, so be aware of that.
Good point.
Yeah.
And the funding fee we talked about with the COE, how does that fit into the loan itself?
Right, the funding fee. Unless the veteran is exempt, usually due to service-connected disability, they have to pay it. The percentage varies based on down payment amount, whether it's first use or subsequent use type of service.
It's variable.
Yes. But importantly, the funding fee can be financed, rolled into the total loan amount.
Okay.
However, and this is crucial for cash-out refinances, the total loan amount, including the financed funding fee, cannot exceed 100% of the property's reasonable value determined by the VA appraisal.
Okay. So the finance fee can't push the loan over the property value for cash outs.
Exactly. Big rule for cash-out.
What about other closing costs? Appraisal fees, title insurance, stuff like that. Any VA rules?
Yes, the VA limits the types and amounts of closing costs the veteran can be required to pay. There's a list of allowable fees. Lenders can also charge a flat fee, typically 1% of the loan amount, to cover their own costs instead of itemizing certain things.
So some protection for the veteran against excessive fees.
Right. And sellers are generally allowed to pay many of the veteran's closing costs, which can be a big help in negotiations. But generally, these closing costs, other than the funding fee and sometimes points on IRRLs, cannot be financed into the loan.
Paid out of pocket or by the seller, usually.
Correct. And one last point on loan basics: the legal documents, the mortgage or deed of trust. Lenders can use their standard forms as long as they include specific clauses required by the VA to protect everyone's interests.
Got it. Okay, let's talk about what you can use a VA loan for. What are the eligible loan purposes?
Big range here. Obviously, purchasing a home, single family up to a fourplex, even construction of a home.
Buy or build.
Right. Also, refinancing an existing VA loan, usually for a lower rate, that's the IRRL, or doing a cash-out refinance of any type of existing mortgage or LANA on your primary home, pulling equity out.
Okay. Cash out is broader.
Yes. You can also use it to refinance a land contract, make repairs or improvements to your home, or even buy a home and finance improvements at the same time.
Simultaneous purchase and improve.
Yep.
Energy efficiency improvements are another eligible purpose. Buying a unit in a VA-approved condo project, and even buying a farm residence, though the loan is based only on the value of the home and residential land, not the whole farm operation.
Can it include a business unit?
Yes, potentially. A property can have up to 4 residential units plus 1 business unit, provided the property is primarily residential and the business part meets certain size criteria.
Okay, that's quite a list of eligible uses. What about ineligible uses? What can you absolutely not use a VA loan for?
Okay, main restrictions. You can't use it just to buy unimproved land. Has to be tied to construction generally.
No land banking.
Right. Can't use it to buy or build a pure investment property. You have to intend to live there as your primary residence.
Occupancy rule again.
Yep. Can't finance a property that's primarily business use. That combined residential business property we mentioned. If the non-residential part is too big, over 25% floor area, or there's more than 1 business unit, it's usually ineligible.
And you generally can't use one VA loan to buy multiple separate properties or units, like 2 separate houses on different lots, unless there are very specific circumstances, like they can't be sold separately, always been treated as one property, etc. It's rare.
Got it. What about getting cash back at closing? Is that allowed?
Generally, no cash directly to the veteran from the loan proceeds. The main exceptions are, again, cash-out refinances, where pulling equity is the purpose, and IRRLs, where limited cash for energy improvements might be okay.
So for a standard purchase loan?
For a purchase, cashback is usually limited to refunds of things the veteran already paid out of pocket, like their earnest money deposit, or maybe credit for prorated property taxes paid in arrears by the seller, but you can't just borrow extra cash.
Okay, clear distinction. Let's swing back to the guarantee amount. We said for full entitlement, post-2020, it's 25% for loans over $144K. Can we break that down a bit more?
Sure. So the Blue Water Navy Act changed things for folks with full entitlement. For loans over $144,000 closed after Jan 1, 2020, the VA guarantee is simply 25% of the loan amount. There's effectively no VA cap tied to county limits for calculating the guarantee itself if you have full entitlement.
So if you have full entitlement and can qualify for, say, a $700,000 loan, the VA guarantee is $175,000. 25% of $700K.
Exactly. Now, the lender might have limits based on secondary market guidelines, but the VA's guarantee calculation is straightforward 25% in that case. Table 3 in the handbook shows this.
What about loans under $144,000? Is it still 25%?
No, the percentages are actually higher for smaller loans, up to that basic $36,000 maximum.
How does that work?
For loans up to $45,000, the guarantee is 50%. Between $45,001 and $56,250, it's a flat $22,500 amount. So more generous percentage-wise on smaller loans, hitting that $36K ceiling at $144K loan amount. Precisely. And remember, IRRLs always get at least a 25% guarantee, regardless of the loan size. And the guarantee amount always includes the funding fee if it's financed.
Okay, that clarifies the full entitlement picture. Now the trickier part. What if a veteran has partial entitlement? They used some before, didn't get it fully restored. How is their guarantee calculated?
Right, this is where you need to do some math. The key is that their maximum potential guarantee is reduced by the amount of entitlement they've already used and not restored.
Okay, so you start with a theoretical max and subtract the used part.
Essentially, yes. For loans over $144,000, you figure out what 25% of the county loan limit is, using the Freddie Mac conforming limit for that area. Then you subtract the amount of the veteran's unrestored entitlement from that figure. That's their available guarantee for that larger loan.
Example. Let's say the county limit means a max guarantee calculation of $150,000, 25% of $600K limit, and the vet has $50,000 unrestored entitlement.
Their available guarantee for a new loan over $144K would be $150,000 minus $50,000, which equals $100,000. The lender knows the VA will back the loan up to that $100K amount.
Got it. And for loans, $144,000 or less with partial entitlement.
It's simpler. You take the basic entitlement amount, $36,000, and subtract the unrestored entitlement.
So if they have $20,000 unrestored,
their available guarantee for a loan $144K or under would be $36,000 minus $20,000, which is $16,000.
What if they've used more than $36,000 and haven't restored it? Say $55,000 used previously.
Then for a loan $144K or under, $36,000 minus $55,000 is less than zero. So they effectively have no basic entitlement left for a smaller loan. They'd likely need a down payment or could only get a loan over $144K using their remaining bonus entitlement calculation. Chapter 2 goes deep on restoration options.
Wow, okay. That partial entitlement calculation is really important for lenders and veterans to understand. It directly impacts how much guarantee is available.
Huge impact.
Right, that was a
Yeah.
very thorough deep dive. We covered a lot of ground based on those handbook chapters. So for you, listening right now, what are the absolute must-remember points?
I'd say, number 1, know the difference between eligibility based on service and entitlement, the guarantee amount. They're related but distinct.
Well,
2, the certificate of eligibility, the COE, is vital proof for your lender. Know how to get it and what the codes mean.
Yeah.
3, understand the proof of service needed for your specific situation, DD 214, SOS, NGB forms, etc. And 4, grasp the basics of the VA guarantee, usually no VA required down payment, how the guarantee protects the lender, and especially how partial entitlement affects the calculation. That gives you a really solid base.
Absolute solid advice. And, thinking back, the thing that might be an aha moment for some listeners is probably that the VA doesn't set its own maximum loan amount for those with full entitlement. It's more about the property value and lender limits. That flexibility is kind of surprising, isn't it?
It really is. It shows the program adapts, to wildly different housing costs across the country. It relies on the market value and lender capacity rather than some arbitrary VA cap.
Which leads to a final thought. How does that flexibility, that lack of a hard VA loan limit for many, actually shape where veterans can buy homes? Does it truly level the playing field in expensive areas compared to cheaper ones? Something to chew on.
That's a great question to ponder. For anyone wanting even more detail, remember the VA Lender's Handbook is online, it's public, and your regional loan center is always the best resource for specific personal questions.
Definitely. Thanks for tuning in for this deep dive with us.